Michael, welcome to Gaze Ahead. It's so nice to have you on the show.
My pleasure. Thanks for having me, Melanie.
So, one of the things that I wanted to hear more about, you and I go way back. It started off with a professor-student relationship and has since evolved. But can you tell me a little bit more about yourself, about your background, your story, and how you got to being the author of this new book of yours?
Yeah, thank you. I've got an interesting background. I think that gives me a perspective that's nice and broad, I think, and really appeals to people that are trying to start up an early stage company. So my first degree was computer science from the University of Waterloo, and I worked for 5 years as a systems analyst, computer programmer, installing systems across North America. And through that process, I observed that the quality of the management that I saw in our organization was not very strong. It was a startup. It was only about 4 people when I first joined it. And I was a little curious about why we couldn't do things better. So I was motivated. I went back to school to get my MBA at the Ivy School. And then I got turned on to finance and stayed and did my PhD. And then I thought, okay, well, that's fine. I'll be an academic. Then I moved to Calgary in 1990 to take up an academic position, and I started angel investing. And again, I started trying to make some impact on some of these early stage companies, giving advice, guidance, and I found out I was spectacularly unsuccessful as an angel investor for a whole bunch of different reasons. And there's that famous Dunning-Kruger effect where, the less we know about something, the more we think we know. And I thought I could influence the CEOs and give good guidance, and they really weren't that interested. And as a small investor, they're not really incented to listen to you. So I was a little disappointed in that. And I thought, well, gee, I better learn more. So I went back to school, which in this case is the real world, and decided partway through my academic career to take a 3-year leave of absence. I worked for the Business Development Bank, now the BDC, in the Prairie provinces here, as domiciled in Calgary, looking at doing tech deals, early stage corporations and later stage corporations. And I found, wow, this is how you make good investment decisions. Because as an angel, I was always trying to think, well, this could work. This could work if this happened and this happened and this happened. Maybe it could work. And I learned through the venture capital process that what you look at is why will it not work? And then try and address those issues. And so certainly one of the key issues why things don't work is the governance isn't very effective in the corporation. And so if we were having a pitch brought to us by an entrepreneur, that seemed reasonable and could have some potential, the first two things we would ask for would be governance documents. We'd say, okay, so give me your capitalization table so I know who your investors are. I know if you're the right person to talk to, if you're the major shareholder, that sort of thing. And also your shareholders agreement, because if those were messed up, then it was going to take too long to sort it out. So I found some interesting outcomes from that. Then fast forward a few years, I thought, well, I can bring this back to the students. After my 3-year leave, I came back to the university. And so I started teaching governance to our undergrads, our MBAs, our executive MBAs, where we met in the EMBA program.
Mm-hmm.
And I found that was well received. And then in recent years, I was asked to be the first site lead for the Creative Destruction Lab Rockies program. And I saw the same issues in that situation with a lot of these early stage tech founders, really smart people, but didn't have a sense of what it takes to build a corporation and what governance really means. So I had some notes that I'd evolved over time. I ran it a couple of times with my classes, with the CDL students, and with some of the CDL ventures. And then I've created this book, I think, that encapsulates some of what I've learned along the way. And as you know, I also had the opportunity to interview some folks, including yourself, who shared their insights into, well, here's really what we think governance means, and here's what founders should understand as they go forward to build their corporation. And so that's been built into the book. And so I've used it now in a number of executive education programs, including for the Canadian Venture Capital Association. I just actually finished a program with them last week. And the work seems to be getting some good traction from people saying, this is fantastic. We want the entrepreneurs, we want the founders to know this. And it's nice you're doing it because they don't believe us when we tell them. So it's nice if somebody independent tells them, here's what they have to think about. So I think we're on a good trajectory here. And so I'm very pleased to have this book almost ready for publication. As we talked just before we started here, it's expected to come out late May, early June of 2023 and be available online, and then hopefully not too long after in the stores as well.
Amazing. So you mentioned governance, and so for our audience, it's one of those words, like it can mean a few different things. If you had to boil it down and make it really Cole's Notes version, how would you describe what is governance when we're talking about to an entrepreneur?
Yeah, it's a great question because usually when you say you need better governance, their eyes start to glaze over and they go, "Well, we don't need a board. We're just a couple of people here working away on trying to solve a problem." And I go, "Yes, you are, but governance is a very broad concept. And governance, from my mind, includes, and this is, I'm quoting from my book now, at its most fundamental level, governance encompasses the purpose of a business activity, the critical elements of that activity, who controls the decision-making process, and who receives the benefits. Effective governance helps build alignment between founding team members, without which there is a higher chance of venture failure." And so that whole idea about how do you create an entity that is going to pull people together, the founder creates a vision of the future, but then they have to pull people into that vision and putting an effective structure around that. And governance, certainly a board is a component of that. But in my book, I talk about how the founder has to go from founder controlled governance, where they and their co-founders are, they're wearing three hats, and this makes life interesting for them. So they're the shareholders, they're the officers, the people running the corporation day to day, as well as the directors. And they're not sure what hat they have to wear. And when they're making decisions, they're not really sure what hat they were making that decision on the basis of. And so you get some outside guidance to be really helpful to them in that process. This is where, earlier along, as you've got just your founding team on the board, you bring along advisors potentially. And advisors, as you know from your background, it can be critically important to just give you, sort of a heads up as to what the things are you're going to run into as you start to build your corporation. Those can be informal or formal advisors. They're also at different levels. You can have an advisor that'll help you at a personal level, like how you can be a more effective leader. They could help you at the corporate level, like here's how you go and sell in this market, or here's technology issues you have to address as you move forward. They could be around the governance level. And here's what it takes to, attract capital. And really, governance is about creating a system and structures that are going to allow you to attract capital to grow your business.
Mm.
Because I mentioned before, one of the things we look at would be your capitalization table, your shareholders agreement. If those are messed up, if you've made mistakes along the way, and I've seen this several times where a corporation hasn't been thoughtful about the way they've raised capital, and they're just doing it willy-nilly, sometimes debt, sometimes equity, not well documented, don't really have a good minute book. And then they go and they try and raise professional capital, and they go, "Well, we don't know what your cap table looks like. We don't know who your investors are. We don't exactly understand where you got to today. And so, until you clean that up, we really can't talk to you." And so just simple things like that, which seem like good business practice, are things that founders, nose down, head down, working hard, building the business, worrying about customers, product, all that stuff. They don't tend to think about that. And I'll add another aspect to this. I did some research based on my work with the Creative Destruction Lab Rockies program, and looked at the likelihood of one of the founders in the program attracting mentor support, which is critically important in that program. If you don't attract mentor support, you're cut from the program. And I found that if the corporation was working on its product market fit issues, as well as governance, as well as financing issues, it had a significantly higher chance of attracting mentor support than if it was just nose down working on, product market fit issues. And so I take that as another sign that, outside, and these are angel investors predominantly, angel investors are critically worried about whether you're creating this effective structure, because they know that there's these problems that are going to evolve over time. And if you haven't thought what those problems could be and haven't set in place systems and structures to address the problems as they evolve, you're going to be much less likely to succeed.
Mm-hmm. And these days, angel investing and norms around angel investing have changed. It's not just somebody it's your brother's friend that can give you money to raise to help your business grow, but it's actually like a very sophisticated group of individuals that oftentimes will invest in a small cohort or together in a business, and they are very educated and very sophisticated investors. So to your point on bringing professional money on later, you actually need to get governance sorted at the earliest stages nowadays, even for angel investment. It's
Yeah, I would
much more sophisticated.
very much so. I would echo that. In my book, I talk about you've got to make this transition. You start with founder-controlled governance, where yourself and your co-founders are the ones in charge of all the decision making. You're the board, and then as you bring angels on, you might add one or two to your advisory or onto your your corporate board, and then you have to transition to a shared control board, which is what venture capitalists look for. And there's a trajectory you have to follow if you want to do that successfully. And certainly angels are very sophisticated individuals. They've been successful business persons, and they're there to help. And that's one of the problems that a lot of entrepreneurs run into, is the fact that they don't really listen well to guidance. And one of the key words that we heard bandied about when, some of these angels and even venture capitalists look to make an investment, they say, I want to have a founder who's coachable, and I want to have a corporation that's investable. And so the founder being coachable entails things like taking guidance. You don't have to, act on every piece of information you're provided with, but you have to at least listen and consider it, because these are thoughtful people that are giving you that guidance. And the successful founder will go out and seek out guidance and say, look, here's issues that I want to work on. Can you help me with these? Certainly, they will seek to develop a board of independent advisors, get somebody independent, a really high potential person that could really help them develop their business, and reward that person. That's the other thing about this whole exercise. The founder has to realize that in order to attract the team, broadly defined, that they need to be successful, they have to share the gains. So, governance entails setting up a compensation system that will attract the talent that you need to build the business. It entails creating, a governance system and compensation is associated with that system for directors and advisors that incent those strong people to come want to work with you.
Mhm.
So you draw them in by saying, look, here's the vision, here's where we want to go, here's the solution we're working on that nobody else had thought about before. So you get people excited about the future of the corporation, say, and here's what I need to help me get there, and here's how you're going to be rewarded for helping me along the way.
Let's break that down. So I'm a founder, or I'm thinking about becoming a founder, let's say, and you're telling me that, I need good governance. That sounds like cha-ching legal fees. Then you're telling me I need to compensate these guys that I'm bringing on. So how do I do that if I have only my own capital? I haven't raised any cash yet. How do you do that with succinctly and without spending too much cash? Do you have any ideas on that?
Yeah, no, there are some templates available. So Y Combinator from the US obviously has some good templates. National Angel Capital Organization from Canada has some good templates. The Canadian Venture Capital Association has some templates for a bit later stage in terms of what shareholders agreements could look like, and other forms of agreements. There are a lot of the law firms around that'll give you guidance at a relatively low cost early on in the development process, because they're trying to build a relationship. And so simple things like a founder's agreement that specifies, here's, who the participants are that are going to bring this entity forward. Here's the roles that we're going to play. Certainly a critical aspect is to have share vesting agreements. And share vesting agreements say that, yeah, we're all in this together, but if somebody leaves before we get to a certain point in time, then they don't get to keep their share of the company. So if there's 4 founders come together, they all got a quarter of the company. Somebody leaves, relatively soon after that's formed, they don't get to keep their quarter of the company. I mean, when you have a capitalization table that's messed up, where there's a bunch of founders that have left and those shares are there and those people aren't there, that really scares off investors. So simple things like that. And then I always go back to the idea about due diligence. So if you're going to then, be bringing on employees, governance entails things like having, good background checks on the people. Make sure you carefully document what you want that person to do, what their compensation is going to be, and then monitor their behavior, because you're responsible as that founder for, any kind of harassment that goes on. You want to make sure they're behaving appropriately, that they're following, ethical guidelines that you believe are appropriate. So there's a series of things that are good business practice. I mentioned some of them in my book. And again, some of these law firms will help you structure that at, a few $1,000s sounds like a lot of money, but boy, oh boy, it can cost a fortune to try and undo some of these mistakes. And sometimes you just can't undo them if you haven't thought about how you want to be careful going forward. IP protection would be another aspect of that. It's about risk mitigation, basically. All of these are about risk mitigation. And I've heard stories of founders that didn't protect their IP properly. And then when they went to try and commercialize it, they found that it wasn't of any value because it hadn't protected it properly. So all that work that people have put into this, the sweat equity they've invested, the hours and the hours to get to a certain point, and then to find out it's worthless because they made a couple of mistakes along the way. I mean, that's a terrible thing to happen to anyone. And so by just thinking it through ahead of time, I think we can help people avoid some of those mistakes.
Agreed. So to your point about how do we do this cheap? Well, there's some free resources available on websites. We'll post some in the show notes after this for our early stage entrepreneurs looking to start a business or raise their first round. What about bringing on advisors and you don't have a ton of cash? What are some of the ways that you can incentivize an amazing advisor to come and join your company, either as, an hour a week or an hour a month? Like what might that look like?
Yeah, it's a good question. There are people around that will give you guidance for free. There's good people around that have been successful, and a lot of them want to help. They want to help develop the ecosystem, help young entrepreneurs be successful. So, if you find somebody or hear about somebody, you can call them up or send them an email and say, "Can you just have a meeting for coffee with me? And I want to run some ideas by you." And most people will give you the time of day. But I always suggest that, these individuals that you contact are well tapped into the community. And so you don't want to disrespect their time or their energy. So if you go to the meeting unprepared, or you're late, or you don't seem interested in why they're there, if you just want to say, just you want to just put their name on your website and say, "I've got this as an advisor," but you don't really care about whether they give you any advice or not. I mean, that gets around. And certainly your reputation is critically important. So, be honest and open with somebody. Say, "Here's what I'm trying to do. Here's where I think I could use some support." And the person might agree to give you guidance around the timeframes that you've identified, an hour a week or an hour a month or whatever.
Hmm.
If it gets to that point, then you have to think about, well, I really do have to reward somebody because I want their time to be valuable time. So there's ways to give options or other kind of share-based compensation early on in the life of the corporation. You want to be careful about that because, you know, equity is really valuable. And if the founder starts to, give out bits of equity here, there, and everywhere, and then finds out they don't own a large chunk of the company, very early in its development, that scares off investors as well, because they want to see that the majority of the shares are owned by the person or the people that they want to be running that corporation. But there are sort of rules of thumb, and I talk about them in the book, as to what your typical compensation would be for an advisor. You want to have a formal advisory agreement, and there's templates that are relatively inexpensive to identify. And you say, "Here's kind of what we want from you. Here's the time commitment. Here's the shares we're going to give you, or the options we're going to allocate to you." And you usually put a window on it, like, "We need your help for the next 2 years, and then we'll talk about it after that, whether it still fits or not." And it's the same with the director. If you find somebody that you think could really be a strong director, they're much more difficult to get to come and help you because of the fiduciary duty and duty of care that a director faces that an advisor doesn't face. So there's significant legal liability for someone serving as a director. So, if you find somebody you think might be a good director, you might want to invite them to be an advisor. Sort of a learning about each other time period can take place. And then if it seems like a fit, then that person may be willing to join, and you may be willing to invite them to become one of your directors. So
Hmm.
those are some of the bits of information I think people could benefit from.
Absolutely, absolutely. And that advisory board to start with the early stage, like pre-seed type companies, can be life changing. And you don't really need a proper, formal board for a little bit longer. Can you tell us about like your gut check on when it's the right time to bring on a formal board in a startup versus an advisory board? Is there like a rule of thumb that you would go by for that sort of line of questioning?
Yeah, it's a great question. And I've got different perspectives from different people that have interviewed. Some say as soon as you reach out and take money from anybody outside of your founding team, even friends, family, or business associates, you're going to want to put a formal board around that corporation just to provide comfort for everybody. I think that's a bit early, to be honest. And it's hard to get like the type of person that you want to serve as a director when you're at that early stage, to be honest. It's hard unless you've got a really compelling argument that you think you're going to change the world, and people want to come along for the ride in terms of that process. So I would suggest, as you get some money from an angel investor, at that point in time, you might want to think about, you get a significant amount of capital into the pot, a few $100,000. You're starting to think, okay, now we can see a trajectory where we're going to want to be raising rounds of financing. And that's how you always should be thinking about it, is about, okay, we raise money, and that's going to get us to a certain milestone. And then we're going to have to raise more money at that point in time to get us to another milestone, and so on. When you get to that point where you're going to have a significant milestone that you're going to deliver against, you might want to think about putting a formal board around that, and maybe even just one outside director. And what you're going to find when if you are able to track venture capital, and it's very difficult to do, as you know, but if you are able to track venture capital, they're going to want a certain kind of governance structure where they're going to have a couple of founder nominees, a few venture capital nominees, and then one or more independent directors mutually agreeable to both parties. And that independent director is a critically important person in that discussion because they're the only one that's unconflicted around that board table. The founders have a perspective, the investors have a perspective, the independent directors should be thinking, they all should be thinking about the best interest of the corporation, but sometimes their mind is somewhat filled up with other issues that are going on. So venture capitalists are worried about, how their portfolio is doing or what the timeline is, what their limited partners are looking for, things like that. So when they have to get an exit out of this, for example, from the investment, things like that. The founders are thinking about job security. They're thinking about, their bonuses, if they're able to meet milestones, those sorts of things. Whereas the independent can sit in there and go, okay, I understand there's different perspectives around this table, and I want to try and work collaboratively with all of you to come up with what we think is the best solution to whatever problem is we're facing right now. So if you can identify, significantly somebody that's well regarded in the community, got significant presence, that has a totally independent mindset and knows something about your business. And it would be really nice if they have been in your shoes before. So somebody that has built a corporation, because one of the things we talk about, directors have to have empathy for the journey that the founder is on. And you personally know how difficult it can be to be the CEO of an early stage corporation, the personal stress and angst that you experience. And so having directors around that table who can understand that journey and give support. We talk about the role of the board, and we've sort of alluded to it being more oversight-ish in terms of, you want to keep an eye on what's going on here. But a board has three critical functions. There's the oversight piece, obviously, make sure that checks and balances and controls and the cash is looked after, all those sorts of things, contracting is done properly. But they also have to provide foresight, which is to help work with the CEO and the management team to figure out what the future could look like and how the solution that the corporation is working on will fit into that future. And then they also have to provide insight to the management team to help them understand the journey that they're on and what they have to do to be successful and some of the, again, things that they're going to run into. So you want people that have been through that path before because they can foresee what's going to happen and be ready and willing to provide guidance to that entrepreneur and that founder as time progresses.
Absolutely. That wisdom that comes with what to do, but perhaps in some cases, more importantly, what not to do. So valuable, so valuable. And, if I could do a do-over, I would have done it this way. Those types of gems that you get from people who've been there, done that are you can't put a price on them. So absolutely. And as a founder, you have some control, like you said, over who's on your board. Especially as you start moving and shaking and raising capital, getting some revenue, creating value in your business. You start being a little bit more able to select that independent, and that criticality of that independent board member is going to be really important. Let's talk a little bit about CEO relationship to the board. A lot of CEOs, first-time CEOs, are learning about how to manage up, what that looks like. And if you're a first-time CEO, likely you've been in the workforce and you've had bosses before. And so can you talk a little bit about, that boss employee perspective of some CEOs thinking the board is their boss and why that could be problematic or beneficial?
Yeah, very good perspective to bring. The CEO's got a very interesting role. They're the person that acts in between the corporation and the board. And the board includes the investors, basically, if you're raising capital from venture capitalists, for example. And certainly, we're all used to the hierarchical model where the CEO provides guidance and direction to the vice presidents and everyone, and go ahead and execute. The CEO is ultimately responsible for the execution, but they're the ones that are providing the direction. The board is an interesting organization, and people who haven't served on boards before don't realize that it's not a hierarchical organization; it's a peer organization. And so everyone around that table has the same vote when decisions have to be made. And so the CEO is not reporting to the board. They are, but then as a member of the board, they're a member of that peer group that's making those decisions. So there is certainly a process to be followed for a CEO to manage their board. And what that means is a couple of different things. If you have quarterly board meetings, the board is coming in every 3 months to say, how are things going? What have you learned? What have you done differently as a result of what you've learned? Where should we go in the future? Those sorts of things. But one of the things boards don't like to have is surprises. And so there's this relationship that you as the CEO have to build up with your fellow board members that says, look, here's something I'm working on. Even between board meetings, you contact your directors and say, look, here's something we're working on. I just wanted to let you know, here's an issue. Here's what we want to do to address it. Do you think that's appropriate? What else could we do? So you can reach out for support in between board meetings. It's not just a reporting function. A lot of founders think that the role of the board is keep an eye on them, and it's a reporting function. So they'll go in every quarter and say, here's what we did, here's what we learned, here's where we're going, full stop. And that's not the purpose of the board meeting. The purpose of the board meeting is to get that out of the way as quickly as possible, so you can spend quality time drawing the wisdom out of those directors who are there as partners to help you build your corporation. So one of the tools that I've heard people talk about, there's a couple of different ways you can frame this. So one of the ways a founder can get that kind of mindset around the table is to walk into the meeting, the board meeting, and say, I really want to help. I really want to thank all of you for being here today. Help us, the founding team and the management team, work to build this business. And it changes the mindset around the board table, because the directors now realize they've got a responsibility, not just to oversee, but to be part of the go forward to help build. Some thoughtful directors at the end of a meeting will say to the CEO, did you get out of this meeting what you wanted? Are you now able to go forward and build the corporation given the guidance that you received in the meeting? So that collaborative mindset is something that's different from what certainly someone who's had a history of working in organizations and hierarchical organization, and now their first time CEO, they may not understand that. They think they report up to the chair, and that's not really what goes on in that context.
Absolutely. It's that mentality of being a peer and being part of a team that's guiding and doing the best by the shareholders, right? Doing the best work by the shareholders for creating value for shareholders. That's the intention. And when a CEO, one of the things I think is noteworthy for our CEOs out there is when, if you're thinking about keeping your job, showing up to a board meeting as a peer and being very succinct in your ask and what you need, rather than asking what to do, is a way that you can maintain your position as CEO. Because at the end of the day, if you're always looking to your board to solve all your problems or to guide you, you're not really, frankly, doing your job. You need to be solutioning, and you need to be showing up as a peer at your board meetings. And that's a big message that we need to send for those first-time CEOs out there that feel like their board is their boss.
Yeah, no, very much so. It's a very good way to frame it. I mean, the board is counting on management to run the business. The board is counting on management to come up with the strategy. And so the board doesn't want to run the business. That's not their job. That's management's job. So the CEO, has choices and alternatives and brings them forward and says, and here's my recommended solution, but I want to hear your feedback and I want to understand why this would work or this wouldn't work. And a lot of times, the board might say, well, I don't think that's going to work. And the CEO goes, I want to do it. And they say, okay, fine. You're the person responsible for executing. You go ahead and do it, and then come back and report, and we'll discuss what happened here. So yeah, there has to be that mindset that the CEO is not there at the behest of the board. The CEO is there to get guidance and to use the value that the board can provide to them, because they're the ones that are, down there working day to day to try and create that long-term value. And the board certainly doesn't have that same perspective. Yeah, I totally agree with that perspective.
One of your panelists in one of the courses we were doing a panel for recently said something, and it stuck with me. The CEO really has 3 jobs: set the vision of the organization, hire the best team, best management team, and keep the company fed, meaning don't let them run out of money. And if you boil it down to those 3 things as a CEO, it kind of oversimplifies, but those are really the main things that you're up to as a CEO. And hiring the best people also goes up, and choosing the best partners for your board, choosing the best partners for your venture capital, partnerships and investments, making sure that when the going gets tough, because it will in a startup, it just will, that you have a relationship, that you can get through the work together. You can get through the hurdles together. Let's talk about the human aspect. You mentioned calling directors between meetings and things like that, building trust. How important is it that you have a relationship beyond just the working relationship with your board members in your mind?
Yeah,
Like a
and I'm going to just
friendship almost.
yeah, I'm going to pick up on just a comment you made and then cycle back on that. Your comment about think about who you take money from is critically important, because a lot of times and this goes to the question about the personal relationship. A lot of times, founders are sitting there going, we need money, and somebody offered money, we'll take it. And you go, well, that might not have been a good fit. And that party doesn't have the same time frame that you think. They don't have the same ability to support you. So one of the recommendations I have is for founders to do your due diligence on anyone that you bring onto your capitalization table. Like, find out how they are to work with. Talk to CEOs of other corporations they've invested in. Any venture capital firm's going to tout the firms they've invested in. So contact those people and say, look, I'm a first-time founder. I'm looking to take capital. How have they been to work with? And so also, you want to make sure that you know who's going to be the partner that's going to be assigned to your corporation. So, if they're going to make an investment, you want to say, okay, well, who's the party in your firm that's going to serve on our board? I want to see if that person, if I think that. So, don't just take money blindly. Take smart money and money that can really help you build your business, and then work on that relationship. So I'll give you an example. When I was working in venture capital, my former boss, told a story where they'd made an investment in this corporation, and before the investment had been gone in, the management team was quite open, welcoming. It seemed quite pleased to have them there. And then at the first board meeting, they were very reticent, they were very hesitant, didn't want to share anything. They seemed somewhat scared. And he said, well, why are you behaving differently now? I thought we had a good relationship. They say, well, because now you've got all these terms and conditions that would allow you to do things that would, impact our decision-making power. And those are part of what the venture capitalist negotiates as part of their responsibility to their limited partner investors. They've got a fiduciary duty. The problem for a venture capitalist is they wear two hats. They raise capital from institutional investors, so they've got a fiduciary duty to those corporations or endowments, pension plans, whoever, as well as then when they serve on the board of the corporation, they've got a fiduciary duty to the corporation on whose board they serve. And so you've got this dual fiduciary responsibility. But when the VC walks in the room and serves on your board, their sole responsibility is to your corporation. However, they have to worry about the fiduciary duty to their limited partner investors. So they do that through some contracts they create that give them some veto rights as an investor, not as a director. And so that's where that came from. So anyway, in this particular context, these founders were saying, well, you've got all these rights as a shareholder that could potentially impact the decision-making process. And my former boss said, no, that's not what we're here for. He said, we're here to work with you collaboratively. So we're going to take these agreements, we put them in a drawer, and now we just work like every other director around the table to try and create value. So like I said before, the boards don't like surprises. So as a CEO, don't hold back negative information because you think it's going to impact negatively on you and the board's not going to trust you in the future. Boy, if you don't share that information, they find out about it, they certainly won't trust you in the future. Mm-hmm. I don't know if you can hear it now, I'm getting a lot of rain on me right now, so there's a bit of rain coming down. And then another situation where I was coming in to make an investment, and the corporation had evolved. So it had developed a product on time, on budget, and taken it to the market, and the market didn't want it. And so now the company has, with $3 million into this investment, and the company's not doing what it was supposed to do. And now it's time for a pivot. And you go, okay, are we going to support the management team to pivot, or are we not? And the decision was made to support the team to pivot. And it turned out to be a successful strategy. But I asked one of the other institutional investors, one of the other VCs, why were you willing to do that? I said, because the CEO never misled us, did what they said they were going to do. They're always honest and open about what was happening, and they delivered. So I said, why would I not support them? So that idea about, not sharing is really not a good strategy for a founder. I mean, people know there's going to be hiccups along the way, as you correctly identified. And so the board wants to be there, but you better have an idea about how you're going to get out of that situation, which goes to your earlier point. So don't just say, oh no, the world's not unfolding the way we thought it was going to be. Say, here's what we learned. Here's what I think we have to do as a result of what we learned. How do you think about that strategy? Do you think that's appropriate, or would you just suggest something else? So that's the mindset that you have to have. Use your board as a strategic resource. And the words I use, Sean Abbott from Inovia Capital always uses, to de-risk and accelerate your business development. So think of how the board can be a strategic resource for you as you move forward.
Mm. Sean does have wise words in certain areas. One of the things that stuck out to me in one of his blogs was, don't expect your CEO of a startup to send you, pages and pages of board materials weeks before the board meeting. Expect a couple of days before and review it before, and then get right into the meat of the conversation. To your point earlier, it's not a progress report. It's a juicy conversation about strategy. That's each board meeting needs to be about that. And I thought that was great advice because, yeah, we kind of err on the side of like, look at all we've done. Look at all these milestones we've accomplished in the last quarter, but really the value of that beautiful room and those people in the room is about the juicy stuff, the stuff that is helping you guide your strategy and your decision making for the future, not on the past. So yeah, use your board, choose wisely, use your board. And I like saying that it's like a bit tongue in cheek, because there are founders out there that I know are struggling with cash and are kind of in the point where they're like, I'll take whatever I can get. So choose your board wisely, but make sure you're raising capital in time to be able to choose your board wisely as well. Takes a long time to raise capital. Takes longer than you think.
Yeah, very much so. And that's part of the process of make sure you've got all your ducks in a row, make sure there's no hiccups along the way. Because if somebody comes in and looks at your governance and goes, hey, that doesn't make sense. I don't know how you got from where you are to where you were to where you are today. And you're in tough shape. So that goes to the hiring, well, as you talked about. So, get people around that have done this before. A lot of times people say, you need your product development person, you need your tech people, and do contract CFOs because you can't afford the CFO. And I think if you can bring a good CFO or good business development person along early in your development, that'll help you avoid some of those hiccups along the way.
Absolutely. Absolutely. As founders, it's so easy to put your head down, just focus on getting to that next milestone of revenue or what have you, and not spend work on the business. And those minutes on the business are just as important as those minutes that you spend in the business. And it's hard to convince founders of that. Let's talk about, let's kind of do a little bit of a broader scan on the market right now. It's an interesting time, Q2 2023, we had an interesting thing happen with Silicon Valley Bank recently. Can you talk a little bit about what you're seeing in the venture capital markets and in the early stage investment markets, Michael, and how you foresee this unfolding in the next few months?
Sure. Silicon Valley Bank was brought down for a number of different reasons. One was poor governance, and that'll come out in the wash. But their board had one person that had some financial industry experience, and that person was not on the risk management committee. And they were sitting there with a mismatch on their assets and liabilities. I'll just very quickly go through this. So they had these long-term assets, which were US Treasuries, and we knew interest rates were going to rise, and they didn't hedge off the interest rate risk. There was no one on the risk committee. And during the same period, their chief risk officer was not in position. They had left. So for 9 months, they didn't have a chief risk officer. So that was a governance failure. But the upshot for early stage corporations now is that source of capital that they were filling is not there anymore. And that source of capital was vitally important because Silicon Valley Bank filled a niche where they would lend against revenues or, against future revenues, even in some case. And they would sort of give bridge financing in the sense that they would lend money until you could close your next round of financing, and then you would pay off the loan out of your next round. And that source of capital has gone away now. And so traditional lenders look more at EBITDA and that sort of traditional banking measures. And so it's going to make it more difficult for those early stage companies now to be able to raise that kind of risk capital that Silicon Valley Bank was providing to them. So the upshot is you're going to have to be a bit more thoughtful about where you get your capital from. You're going to have to maybe take more than you want in a round, so you've got a longer runway, so you don't run into a situation where you need a bridge financing to get you to where that milestone is, and then you can raise more equity as a result of that milestone. So it's changing the dynamic of the relationship with the investors. The investors are going to want a bit more control. They want a bit more money in rather than what they used to do in the past. So I think those are some of the takeaways for founders to be thinking about. Whether another financial institution will come in and fill that gap, I don't know, because that's as the evidence has shown out, that's a very risky position for a corporation to be in as a financial institution, where they had a lot of short-term deposits. I mean, they had demand deposits like $80 billion or some ridiculous amount like that, and then 48 billion was drawn out in a day. And so that creates this need for liquidity, and they're sitting on all these long-term assets that have fallen significantly because interest rates have risen, and they take a hit, and basically their equity went away. They lost $16 billion, and that was their equity base. So that those are what happened there. Uh, we could write a case on how not to run a financial institution based on what transpired there.
Mhm. Yeah, and fear and these types of stories create, an emotional reaction, and we're all humans at the end of the day. And so venture capital are kind of reassessing, how do they do their due diligence? What are they doing? What are they missing? And it's a tough market for founders right now, I've heard, in raising capital, especially in the seed and Series A. Right now is an extremely tough time. And so to all you founders out there that are raising capital, we feel you. And the wise words today are get your ducks in a row. It's worth the investment to make sure your governance is in order and that you have the right partners and the right paperwork, so that you can raise money when the markets do open up and when you're ready to. So thank you for your wise words, Michael, on this. I think a lot of people are going to be interested in reading your book, getting to know a little bit about the work that you do. I will post in the show notes where we can find your book, where we can buy your book, and how we can get a hold of you if you're okay with that.
Yeah, sure. Thanks, Melanie. Always a pleasure speaking with you.
Awesome. Well, I'm looking forward to seeing how this rolls out, and I'd love to check back in with you in a year or so and see what the markets are doing, what you're thinking, some thoughts that might have, come up in the next year as your book rolls out and as more people kind of learn from you and see what you learn from them. So let's get back together in about a year and see how that goes.
My pleasure.
Okay.